One chaotic, disappointing year is ending. Another one is likely in store. In October, the IMF released its annual economic outlook projecting weak growth across the world in 2023. It placed particular emphasis on three issues: high inflation and central bank tightening, Russia's invasion of Ukraine, and the continued effects of COVID, especially in China. HBR asked three experts about what to expect for the economy in 2023, and how things have evolved since October. Meir Desai is a professor of finance at Harvard Business School. Karen Dinan is a professor at Harvard and a senior fellow at the Peterson Institute for International Economics. And Matt Klein is an economic journalist and the author of the Overshoot newsletter. We put the same questions to all three. Their replies, edited for length and clarity, are below. Let's start with inflation and interest rates. Where do things stand as the year comes to a close? Meir Desai: we've lived through a seismic change in rates that we're still digesting. Those belated increases, along with improving supply chain considerations, have done well in improving the inflation outlook. But the effects of those interest rate increases are still being felt in terms of consumer behavior, firm investment plans, and asset prices. While the runaway aspects of inflation have ameliorated, we are well below a sustainable rate of inflation. The final push towards sustainable inflation levels will require a longer period of sustained higher rates than people imagine. Said another way, getting to 4 to 5% inflation will happen by May 2023, but getting back to 2% 3% inflation will take longer and be more painful, triggering a sustained debate regarding the dual mandate of the Federal Reserve. Karen Dinan: inflation is very high no matter how you cut it. I would put the underlying trend in the United States at around 5%, which is way above the Fed's target and the highest level in 4 decades. Interest rates have risen sharply over the past year as a result of the higher inflation and the Fed tightening in response. Rates on new mortgages have more than doubled relative to where they were a year ago. They touched 7% in October and November, a level we have not seen since the early 2000s. Matt Klein: the inflation of the past few years has been attributable to the pandemic and, to a lesser extent, to the Russian invasion of Ukraine. Sudden changes in businesses' ability to produce collided with sharp changes in the mix of goods and services that consumers wanted to buy, leading to both gluts and shortages across the economy. The good news is that most of the inflation attributable to these one-off factors seems to be on its way out. Overall inflation probably peaked over the summer. The bad news is that there also seems to have been a modest uptick in the underlying rate of inflation from around 2% a year to 4 to 5% a year. What will the labor market look like next year? Are the recent wave of layoffs a sign that a soft landing without job losses isn't possible? Meir Desai: the labor market remains remarkably strong at year-end, and it seems inevitable that it will weaken. The only question is the pace and severity of that weakening. It's conceivable that the weakening will be slow and moderate, but the larger issue is a possible decline of consumption. Consumers are facing higher prices, higher interest rates, declining savings rates, more borrowing, and lower wealth levels. For now, consumer spending has held up. As the economy slows, we could be facing a longer consumer-driven recession rather than just significant declines in investment and associated losses in employment. These declines in labor demand will likely center on white-collar workers. For that reason, we could continue to feature a relatively healthy unemployment rate, 4% 5%, and still have a struggling economy for a longer period of time. Karen Dinan: there's a lot of uncertainty about where the U.S. labor market is going. Notwithstanding the news about layoffs at some companies, job growth overall remains robust. The labor market is still really tight, with about 1.7 job openings for every unemployed worker. All this is creating wage pressures that are feeding through to prices. The Fed's hope is that bringing labor demand back in line with labor supply, without a lot of job loss, will be enough to reduce inflation back to its target level. But history suggests that won't be enough. A more likely scenario is that the unemployment rate will have to rise considerably to reduce wage pressures sufficiently to wring the excess inflation out of the system. Matt Klein: underlying inflation seems to have accelerated from around 2% a year to 4 to 5% a year, because the pace of wage growth is several percentage points faster than the long-term pre-2020 growth rate. There are basically three ways of interpreting this. 1. Wage growth has been unusually fast because lots of people were changing jobs, but this churn will go away on its own. 2. Wage growth is unusually fast because there is a mismatch between the huge number of open positions and the number of available workers, which means that it might be possible to persuade companies to cut back on hiring without pushing the economy into a deep downturn. 3. Wage growth is unusually fast because too many people are employed and feel secure in their ability to find a new job, which means that inflation will only go away if a lot of people lose their jobs. The first two interpretations are both consistent with the soft landing scenario. Some perspective is in order. Around 250,000 Americans have been filing for unemployment benefits for the first time every single week in 2022, while around 6.5 million Americans were hired each month. Those hiring numbers dwarf the layoffs that have been announced so far. How important are COVID and the war in Ukraine to next year's economic outlook? Mir Desai, unexpected geopolitical events, as always, remain wild cards. Specifically, China's ability to navigate an exit from zero COVID safely and the European exposure to spiking energy prices remain critical risks. The success of China's reopening has potentially opposing inflationary effects by lessening supply chain disruptions but also contributing to global demand for commodities and energy. Karen Dinan, it does not look like COVID shutdowns are going to weigh heavily on economic activity, especially now that China is rolling back its zero COVID policy. But COVID is still very relevant in the sense that disabilities related to past cases of COVID and ongoing fear of the virus appear to be factors impeding the return of some workers to the labor force. The labor force participation rate for older adults in the United States is still well below its pre-pandemic level. And that's contributing to the worker shortage that is pushing up wage inflation. The war in Ukraine also remains a key storyline for the global economy. The most important channel is that the restricted supply of Russian natural gas has created an energy crisis in Europe. This crisis appears to have tipped some European economies into recession, and that has major implications not only for those economies, but also for their trading partners. Matt Klein, COVID is probably not going to be a major factor for the economy in 2023 unless there are new variants that are extremely dangerous even to those with booster shots. China's COVID lockdowns this year have had surprisingly little economic impact on the rest of the world, except insofar as they have reduced the pressure on commodity prices. China's reopening could lift commodity prices next year, although much will depend on how they go about it, and whether they change their mind. The economic impact of the war in Ukraine for the rest of the world probably peaked back in the summer, if not earlier. The damage that has been done is mostly baked in for everyone outside of Russia and Ukraine. That said, there is room both for positive surprises, a just peace settlement, and negative ones, a major escalation of the war.